Welcome to the deep dive. Today, we're tackling something everyone faced back in early 2020. Just profound uncertainty. When the world feels like it's completely upside down, how do you even start to navigate it? Our mission today is to unpack exactly that, but through the unique lens of a specific investment fund. We're going to explore how they confronted the chaos of 2020, what strategic decisions they made under, well, immense pressure, and the lessons learned amidst truly global disruption.
Yeah, and we'll be drawing our insights mainly from two critical letters from the fund's CEO. The first one's from March 2020, right when the pandemic was hitting, unleashing those initial shockwaves. It captures that immediate kind of raw response. And the second is their annual letter from January 2021, which gives a full reflective view on the whole turbulent year. It's a really fascinating case study, I think, in how a disciplined long-term strategy fares when it's, put to the ultimate test.
Okay, so let's step back into early 2020. It was, well, putting it mildly, an eventful start to the year. The COVID-19 pandemic was just beginning to hit, sending shockwaves everywhere. For an investment fund, the immediate priority wasn't just about returns, right? It was about the fundamental mechanics of just operating, what was really at stake there.
Well, what's really illuminating, I think, is how the CEO highlighted the absolute necessity of core functions just continuing seamlessly. The Fundsmith equity fund had to be able to price its holdings accurately, let investors buy in or sell out, and critically provide liquidity when people needed to withdraw their money.
Right, in a panic, that's crucial.
Exactly. If you can't access your cash or even know what your investments are worth, trust just evaporates. There's that great quote from Rick Mears, the Indy 500 winner: "In order to finish first, you must first finish." For them, it meant prioritizing being contactable, giving clear information, and executing every dealing instruction flawlessly. That operational resilience was paramount.
And how did they actually perform during those chaotic first few months? In that first part of 2020, the fund was down, what, 7.9% year to date?
That's right. But here's where their philosophy started to show its strength. It significantly outperformed the MSCI World Index, which was down 15.7%, so roughly double their decline.
Wow, yeah.
And against the MSCI World Value Index, which plunged 22.0%, and the FTSE 100 down 23.8%, their outperformance was even more stark. The CEO had this long-held skepticism about value stocks protecting investors in a downturn.
Right, that idea that cheap stocks are safer. What was the deeper lesson they drew here?
Well, that skepticism, which often runs counter to traditional thinking, proved remarkably prescient. The CEO's view was basically that companies with low valuations are often cheap for, well, very good reasons. They might be heavily cyclical, maybe too leveraged, generate poor returns on capital, or just face fundamental structural issues.
Not exactly resilient quality.
Precisely. Those characteristics are hardly a recipe for resilience when the economy's in free fall. And the performance numbers really underscored that. It illustrated that true quality, not just a low price tag, is what offers protection and maybe opportunity in a crisis.
So with that as the backdrop, how did their actual portfolio strategy adapt? You mentioned companies like Amadeus and airline reservations and intercontinental hotels. They were right in the firing line.
Yeah.
How did they handle those?
They immediately focused on aggressive cost cutting, conserving cash, and securing enough liquidity to survive a scenario where they might literally have, get this, 18 months or so with no revenues.
18 months, that's bracing.
It really is.
Hmm.
But it wasn't about selling them off in a panic. It was about supporting them through this unprecedented halt in their business. They had conviction. They estimated that even if their equity in those two just vanish in a worst-case scenario, it'll only be about a 5% loss for the total portfolio.
Okay, so painful, but maybe not catastrophic.
Exactly. Manageable, let's say. And on the flip side, about a third of their portfolio companies like Microsoft, payment processors, Clorox, Reckitt, Benckiser were actually expected to see increased revenues. This really highlights their buy good companies philosophy, seeking businesses that can adapt or even thrive in wildly shifting conditions.
And the CEO used this powerful analogy, didn't he? Comparing the COVID virus to the global economy's own health.
Yeah, it really resonated. He compared the virus, which is most lethal to weakened immune systems, to the global economy itself. His argument was that the economy had a weakened immune system because the emergency measures from 08-09, things like massive deficit spending, super low interest rates, QE, were largely still in place a decade later when the virus hit.
So that pre-existing fragility made things worse.
That's the argument. It wasn't just the virus. The underlying conditions amplified the impact. Policymakers had already used many of their big tools during the financial crisis, leaving less room to maneuver this time. This underlying fragility, the thinking goes, created the perfect storm for panic when a new crisis hit. But what's really interesting is that amidst all that market panic, opportunities actually popped up.
Ah, okay.
The fund bought two new holdings, companies they'd been watching which got hard hit, either because of temporary overexposure to China or what they called a classic glitch,
A glitch, meaning,
like a short-term fixable issue that temporarily knocked down the price of an otherwise high-quality business. It just illustrates how patience and strategic clarity, even when everyone else is panicking, can create real opportunity. They focused on what they could control: service, finding new investments, supporting their team.
okay, so let's fast forward to the end of 2020. After weathering that initial storm, how did it all play out by year-end? The performance story must be quite something.
It really is quite something. The Fundsmith Equity Fund finished the year up a staggering 18.3%.
18.3%.
Yep. And put that in perspective. The MSCI World Index was up a respectable 12.3%, but the FTSE 100 was actually down 11.5%. So the fund was a real standout. It even achieved the position of second best performer in its sector since it launched.
Wow, that's a testament to their approach. Who are the big winners driving that?
Yeah, it really was. Looking at the top five contributors, PayPal led the charge, adding 5.1% to returns. Then IDA-XX at 3.1%, Microsoft at 2.8%, Intuit 1.5%, and Facebook 1.4%. And you'll notice Microsoft, PayPal, IDA-XX, they're repeat top performers. That says a lot about the consistency and resilience of those businesses.
And it links back to that glitch idea, right? Finding quality when it's temporarily unpopular.
Exactly. It perfectly illustrates that concept. Truly high-quality businesses are rarely cheap unless there's some temporary fixable issue creating that unique buying window.
And on the other side of the coin, who are the bottom five contributors in 2020?
Right, the laggards. Amadeus was down 1.1%, Sage 0.6%, Intercontinental Hotels also 0.6%, Becton Dickinson 0.4%, and Philip Morris 0.2%.
But even these, I guess, still reflect that commitment to quality you mentioned.
Absolutely. Take Amadeus and Intercontinental Hotels. Sure, they had a tough year with travel restrictions, obvious reasons, but their business models proved way more resilient than the actual airlines or hotels they serve. For instance, Amadeus shares fell 13.5%, but the broader Bloomberg World Airlines Index dropped a much steeper 27.9%.
Okay, that's a significant difference.
It is. Similarly, Intercontinental Hotels was down 9.9%. Compare that to the Dow Jones U.S. Hotel and Lodging REIT Index, down 35.1%. It just underscores their buy good companies principle, even in really hammered sectors. Sage, well, they faced challenges with their cloud migration strategy, a common issue for legacy software firms. And Philip Morris was noted for its big push into what they call reduced risk products, RRPs, like IQOS.
Heated tobacco, vaping products.
Exactly. Products the company argues present a lower health risk than traditional cigarettes. It's a fundamental shift in their business. And interestingly, this focus even got them included in the Dow Jones Sustainability North America Index, despite the, lingering societal views on tobacco.
So with that strong performance overall, and the market still shifting, what strategic portfolio changes did they make as 2020 unfolded?
They made some really strategic moves tied directly to that don't overpay principle. They sold their stakes in Clorox and Reckitt Benckiser. Now, these did great initially with the rush for cleaning supplies and all that, but the fund felt their valuations eventually got too high, didn't really reflect their more, let's say, pedestrian nature in normal times.
Got it. Sold high, what did they buy?
They seized opportunities from the panic. They bought Nike and Starbucks, companies with strong brands, high returns on capital, good growth prospects whose share prices fell over 40% during that initial pandemic fear.
40%. Wow.
Yeah. Nike, for instance, adapted incredibly well with its direct-to-consumer digital shift. Starbucks showed amazing customer loyalty, success with drive-thrus, especially after its main China competitor, Luckin Coffee, imploded in that fraud scandal. They also added LVMH, getting exposure to luxury goods, which, maybe surprisingly, held up quite well thanks to resilient demand from wealthier consumers. These buys really exemplify that glitch strategy in action, finding quality on sale due to temporary issues.
This all feeds back into their core investment strategy, right? Those three simple steps: buy good, don't overpay, do nothing. Let's get into that first one. Buy good companies. What does that really mean for them day to day? How did it show up in 2020?
It means going much deeper than just surface numbers. They do this look-through analysis, comparing their portfolio companies against major indices like the S&P 500, FTSE 100 on fundamental metrics. And the numbers, well, they're pretty compelling. In 2020, despite everything, their portfolio showed consistently superior metrics. For example, their companies had a 25% return on capital employed ROCE. That basically measures profit generated for every dollar of capital used.
And how does that compare?
Well, compare that to 11% for the S&P 500 and just 10% for the FTSE 100. Big difference. Their gross margins, operating margins, cash conversion, interest cover all significantly better too. Now, no business is truly non-cyclical, but they argue they control the degree of cyclicality through careful stock selection. It's also kind of striking their portfolio companies average nearly a century old, founded around 1922 on average. And yet they still achieved an 8% weighted average free cash flow growth in 2020. That points to time-tested, resilient models.
Okay, so you find these good companies. Step 2 is don't overpay. How do they gauge that, especially in a year with such wild market swings?
They really focus on free cash flow, or FCF yield. That's a key valuation metric for them. It essentially tells you the cash profit per share relative to the share price. Gives you a sense of the yield you're getting from the company's actual cash generation. In 2020, their portfolio's FCF yield went from 3.4% down to 2.8%.
Meaning they got more expensive.
Exactly. It indicates a higher valuation because share prices grew faster than the underlying cash flows. Now, if you compare that 2.8% to the S&P 500's 3.7% FCF yield or the FTSE 100's 4.2%, it shows their companies are more highly valued by the market. But their philosophy here is critical. They strongly believe highly rated does not equate to expensive any more than lowly rated equates to cheap.
Right, it's about the quality justifying the price.
Precisely. It's about the underlying quality and the long-term growth potential justifying that higher rating, especially if that quality compounds consistently over time.
And then the final part, the intriguing do-nothing element. What does that actually mean for an active fund? Why is it so important?
Well, it's fundamentally about minimizing costs and just letting great businesses compound their value over the long haul. Their goal is minimal portfolio turnover. They don't chop and change holdings frequently. In 2020, turnover was just 4.1%. That is incredibly low for an active fund.
Really low.
Yeah, and that translates directly into incredibly low voluntary dealing costs, just 0.03% of the fund's average value. It's a real testament to their long-term conviction that, get this, 9 of their portfolio companies have been held since the fund launched back in 2010.
Wow, over a decade.
Exactly. And this focus on minimizing costs goes beyond just the headline fee, the OCF or ongoing charges figure, which was 1.06%. They introduced this idea of the total cost of investment, TCI, which includes those dealing costs, bringing the total to 1.09%. But the key takeaway for you, the investor listening, is that the impressive performance numbers we've been discussing, they're already reported after all these fees and costs are taken out.
Okay, that's important context. So it's clear their strategy really worked through 2020. But let's zoom out a bit. What about some of the big market narratives that year, especially those constant tech bubble warnings we kept hearing?
Yes, the tech bubble. It's a classic theme, isn't it? Commentators were frequently warning about it, drawing parallels to the dot-com era, especially with the NASDAQ up over 40%, the MSCI World IT Index also up over 40% in 2020. Big numbers. But the fund challenges this narrative directly by looking at its own sector exposure. Technology is their largest sector at 28.9%, yes, but consumer staples is right behind at 27.0% and healthcare at 22.6%.
So consumer stocks combined actually outweigh tech.
Pretty much. And maybe more importantly, they argue that these broad sector labels like technology are often just unhelpful, even misleading. Think about it. Companies like Amadeus, Facebook, Microsoft, Intuit, PayPal, Visa, they all get lumped under technology. But they do vastly different things. Airline reservations, social media, accounting software, payments. Each has its own distinct underlying growth drivers. Just slapping a technology label on them doesn't really help you evaluate them properly, does it?
No, that makes a lot of sense. It requires a much more nuanced view. And speaking of evaluating companies, they also talked about a really fascinating structural shift, the rise of intangible assets.
Yes, this is really compelling, I think, for understanding modern valuations. Today, the main assets for many leading companies aren't tangible things like factories or machinery or land anymore. Instead, they're intangible assets. Powerful brands, patents, complex software, network effects. Where a service gets more valuable as more people use it, like social media or payment network. These intangibles often generate significantly higher returns, but they cause a tricky accounting problem. Think of it like this. You build a factory, that's a clear asset on your balance sheet. Easy. But if you spend millions creating a powerful brand or developing groundbreaking software, accounting rules often treat that spending as an expense immediately, even though it's creating huge long-term value.
So it makes the company look less profitable in the short term.
Exactly. It can depress reported profitability, which potentially makes simple price-to-earnings ratio comparisons between companies with different kinds of asset bases almost meaningless.
So it's not really comparing apples to apples anymore then.
Precisely. They show this chart illustrating the steady, undeniable rise of intangible investments by U.S. corporations. It actually overtook tangible investment back in the 1990s, right as the internet age began. This fundamental shift makes it incredible.
Huh. So the index itself is changing.
Yeah. The CEO highlights that they are not the same companies, and at least in part, not even the same sort of companies.
Uh-huh.
Now, the phrase, "this time it's different," can be dangerous in investing, we all know that. But sometimes it actually is different. And missing those fundamental inflection points can be really detrimental to your long-term understanding and your wealth.
It's easy to call 2020 unprecedented, but they quote Mark Twain, right? History doesn't repeat itself, but it often rhymes. What rhymes did they find in past pandemics?
That's a crucial bit of perspective, I think. It grounds their analysis. They point out there have been like 6 identifiable pandemics over the last 130 years or so. Russian flu in 1889, Spanish flu, Asian flu, right up to swine flu in 2009. And the overwhelming conclusion they draw from looking back is that pandemics tend to accelerate existing trends rather than creating entirely new ones out of thin air.
Accelerate existing trends. Can you give an example?
Yeah, the prime example they use is the Spanish flu of 1918-19. It didn't invent the assembly line. Henry Ford had the Model T on one back in 1913. But the pandemic dramatically accelerated its adoption. It helped make mass production mainstream, fueling the economic boom of the Roaring '20s by making things like cars affordable for the middle class.
Okay, so applying that pattern, what existing trends did COVID-19 accelerate for us?
Well, we saw rapid acceleration in loads of areas, didn't we? E-commerce, obviously. Online working, remote work using the cloud, home cooking, food delivery, online schooling, telemedicine, the rise of social media for connection. Even the importance of pets in our lives seemed to jump. Automation and AI also got a huge boost as businesses looked for efficiency and resilience.
And this led to productivity gains in some places.
Yeah, surprisingly, maybe. Salespeople could visit more clients virtually. Some
Mhm.
factories kept production going with half the staff due to social distancing. But of course, not every sector benefited. Airlines, hospitality, traditional bricks and mortar retail, office property, they all faced really severe ongoing challenges.
All these different paths, these shifting trajectories, it leads to their final point about the shape of the recovery, right? We heard every letter, V, U, L, W, bathtub, Mikey swoosh.
Yeah.
But they landed on a K-shaped recovery. What did that mean for you?
The K-shaped recovery, yeah. It describes a scenario where different parts of the economy emerge from a downturn on sharply different paths. Think of the letter K, one arm goes up, the other goes down, or stays flat. And consider this. If you knew a year ahead that a pandemic would cause U.S. GDP to drop 9% in one quarter and devastate travel, hospitality, retail, would you have predicted the MSCI World Index would still return over 12% for the year?
Probably not. Seems counterintuitive.
Exactly. That striking outcome really illustrates the profound dangers of forecasting, and especially of trying to time the market, even when you think you know what's coming. The market isn't the economy, and the economy isn't the market, as they say.
What an incredible deep dive into, well, an extraordinary year. We've really seen how a disciplined investment strategy that buy good, don't overpay, do nothing mantra didn't just weather the 2020 storm, but actually thrived. Operational resilience was key, clearly. And understanding those subtle but profound shifts in the economy, like the rise of intangibles.
Yeah, it really hammers home the importance of understanding the underlying quality and long-term potential of a business rather than getting caught up in short-term market noise. And just to leave you with a final thought from the fund, they suggest pondering the similarity between a forecaster and a one-eyed javelin thrower.
Okay.
Their line is, neither is likely to be very accurate, but they are typically good at keeping the attention of the audience. So the real question for you to maybe mull over is, are you seeking entertainment and attention-grabbing predictions, or are you after robust, long-term insights for truly understanding the market and making informed decisions?